This seems like a pretty extreme reaction, no?
Well, when you read through the report, it does identify a whole host of things that the Fed wants to address. And it's a bit like reading a report on a plane crash. There's never just one cause. There are a whole bunch of things that come together that lead to the problem, including management at the Fed. But first and foremost, here's the major reason the Fed cites for SVB's failure: management at the bank. The board of directors and management did not manage their risks and did not pay attention to what they needed to keep the bank operating safely. Supervisors, they say, were caught because the bank was changing supervisory regimes and the law had changed and Fed policy had changed, and they didn't completely appreciate the risks that SVB was taking. And then when they did find problems, they didn't move quickly enough to force SVB to make changes. And the Fed board, under then Vice Chairman for Supervision Randall Quarles, changed policies that made it easier for smaller banks not to comply with rules that had previously been in place. There is a half reason also they add to this, and that is that social media and technology may have speeded up the bank run, also the characteristics of the SVB depositors. The board gets most of the blame here, with some Fed officials calling it a classic case of bank mismanagement. They say the board put short-run profits above effective risk management. Compensation packages of senior management through 2022 were tied to short-term earnings and equity returns and did not include risk metrics. As such, managers had a financial incentive to focus on short-term profit over sound risk management.